An interest rate security is simply a security that pays a fixed or floating rate of return. This return can be in the form of interest or dividends, I should say. The issuer usually promises to pay you a specified rate of interest during the life of the interest rate security and to repay the face value of the interest rate security at a predetermined time. Companies can raise capital for development by issuing new shares through a rights issue, going to the bank to borrow, or issuing interest rate securities. By using debt securities, they diversify their debt structure and may not need to forfeit part of the company in exchange for capital. Investors use interest rate securities to generate steady income streams, to diversify an investment portfolio into fixed interest, or to hedge their own debt exposure. The following securities are available on the ASX: corporate bonds, floating rate notes, convertible notes, and hybrid debt securities. A corporate bond is a fixed interest investment, provides regular interest payments during the term of the bond, then returns your upfront investment at a fixed end date or maturity date. Floating rate notes or income securities pay a variable rate of interest which is reset at each payment interval. The rate moves in line with general interest rates. The rate is generally set at a base rate such as bank bill swap rate plus a premium. A convertible note is a type of coupon paying security that converts to the issuer as ordinary shares at maturity. Generally speaking, these securities pay a fixed or floating return until a certain date, when the security can be converted into the underlying share of the issuer. And finally, hybrids are a class of security which combine both debt and equity characteristics. Hybrid securities pay a predictable rate of return or dividend until a certain date. At that date, the holder has a number of options, including converting securities into the underlying shares. Unlike a share, the holder has a known cash flow, and unlike a fixed interest security, there is an option to convert to the underlying equity. So the hybrid structures are now replacing traditional preference shares as the preferred financing tool.